Hello and welcome to Lunch Money. We are the online and social media home for special situations, workouts and capital raising professionals. My name is Nick Samios. I'm the fund manager here at Hermes Capital and I'm your Lunch Money host. So a very, very warm welcome to you. Today, the spotlight is going to be on business assets. There's a lot of talk about of assets and asset bubbles and what have you at the moment. The reality is that on the balance sheet, business assets, depending on how you look at it, lock up cash. And when a business is going through transition, whether it's growth or turnaround, reconstruction, formal reconstruction or informal, the business assets obviously come into play. And there's a question of whether or not they can be used to unlock some cash, whether or not they should be redeployed, retrenched for that matter, replenished, renewed, as the business maybe changes strategy or needs to batten down the hatches and to keep the ship afloat, so to speak. There's a lot of talk of asset bubbles at the moment. We had the RBA governor saying that he's not particularly bothered about asset bubbles. But, in a world of negligible interest rates, I said to someone this morning, the value of an asset is its income divided by the rate of return. If the rate of return is zero, then surely the closer the denominator gets to zero, then the closer to infinity asset prices become, I would have thought, but what would I know? But we know that it is having an impact on mergers and acquisitions, on IPOs and capital raising. What's the impact on corporate restructuring? So there's some of the things we're going to talk about. But first, I'd like you, as usual, to remind you to share, like, or subscribe wherever you are watching us. If you're watching on YouTube, hit the subscribe button. Otherwise, you can listen to us on a podcast. If you're Apple or Spotify or Google, you can subscribe on all those platforms and give us a like and give us a share. How about that? That way, we spread this good information and we spread the word. We're now going to dive into our first part of the show, which is Recipe of the Week. And our guest chef this week is Ian Hyman, the CEO at Hyman's Valuers and Auctioneers. Welcome, guest chef.
Thank you, Nicholas.
Before we get into your recipe, what's been keeping you busy this week?
Well, we've had a frantic start to the year, pretty much a continuation of how the year finished, in the sense that property development, property values are going nuts. We work with a lot of non-bank lenders, and they're out there at the moment because most of the major banks are not really in those spaces. They're busy as. So our property valuation team is flat out. On the business valuation side, we're still seeing a lot of shareholder disputes. I think COVID has placed a lot of pressure on relationships, whether it be family relationships, just partnership type relationships, and we've had an extraordinary surge in share valuations that have been driven by disputes between existing shareholders. So look, as you mentioned, asset prices are strong, and business cap rates on business valuations have certainly dropped quite significantly, which means that you're obviously paying more to buy businesses. Having said that, small businesses are still quite challenging because they've got lots of risks that the large businesses don't have, such as key man, small numbers, high concentration of customers and so on. And that obviously has quite a big dampening effect on those multiples, but still much stronger than it was 18 months ago before COVID.
And so your phone's ringing from, I guess, lawyers that bring these disputes to you. I've said before on this show, it's like marriage. When the money goes, the love goes in some cases. But you found your phone's ringing a lot more, say, in the past couple of weeks than it was, say, in November, December last year.
Yeah, I've literally got half a dozen of those, literally of those situations running right now.
You've given us 7 tips for reviewing your assets, and as I said before, it can be an informal situation where there's been no external advisors appointed, or it could be a formal situation where there's an administrator, and it's not necessarily a turnaround situation. It could be a business growth situation. And you've got 7 tips, and we're going to make those 7 tips available to anybody who asks for them. I'm just going to hit on some of them. You started off with looking at maintenance costs for equipment from prior years with a view to replacing equipment that's experiencing regular downtime. Yeah. Do you want to talk about that for a moment?
Well, this is something, obviously we do a lot of our clients are unfortunately insolvent, but we also have a lot of solvent clients, and we talked about asset management practices, and all too often, particularly in mid-sized businesses, sort of turning over maybe 50, 60, $70 million up to that level from quite small levels. They don't really have any sort of formal review process. And when a major piece of equipment breaks down in their, whether it's a manufacturing process or even if it's a mining services business of some sort, inevitably it leads to a downturn or breakdown of production of whatever they're producing. So one of the things that we've seen over time that is a great lead indicator of ongoing reliability of equipment is how much you spent on maintenance from the year before. And it's easy to lose that when you've got one P&L account for repairs and maintenance. You might have 100 pieces of machinery. So my recommendation literally is for the director to sit down with operations managers at the beginning of each financial year and go, okay, let's go through the major costs, and if there's any equipment there that is critical, that if it goes down, we're basically going to have to stop production. Let's get rid of it now. Let's plan for replacement so that we minimise that significant risk.
Now, it kind of sounds obvious, but in your experience, is it something that's often overlooked?
It's as rare as finding a decent asset register.
Yeah.
So of all the companies that we go into,
complain about that.
Of all the companies that we go into with more than 10 or 15% had an accurate asset register, that would be a lot. So that's 85% plus of businesses do not really value their assets. They don't value the role that assets play in their ongoing success.
Now, you've also said identify surplus equipment that might be sold to raise cash. It might include equipment that was purchased for a specific contract or volume of work that has subsequently reduced. So again, you'd like to think that people know when they look around their fleet or their factory floor what's working and what's not, but not necessarily.
That would be a very dangerous assumption. Again, very frequently, I won't say this is all companies or at the same level of the issue with asset registers, but the reality is that most companies do not look at assets that are no longer in use. We had a matter last week, $1 million production line. The process just didn't work. It was stopped 5 years ago. It was probably worth, if you'd sold it 5 years ago, $100,000 or $150,000. 5 years later, it's probably worth $20,000 or $30,000 now. But more importantly, it's taking up 2,000 square feet in the factory. So it's all those hidden costs that you don't think about. You can't use that space. You can't use the cash, and it's just eating its head off, basically.
And are you seeing more people that maybe there's a lot of talk of it being harder to raise capital. Obviously, I've had multiple discussions of actually we're starting to see deals that really shouldn't be coming to us. They normally go to banks, but it's just getting too hard to put them through the banks. I mean, are you seeing people coming to you and selling stuff because they just can't raise money and they've had to go through have a look through the ship to see what needs to be tossed?
Yeah, well, that's particularly relevant in the property space. Anything on the commercial, industrial, or even and particularly in the development side, the non-bank lending, and you've just seen this, Nick, too, in your own dealings. The number of lenders has increased exponentially over the last 18 months. We've seen a lot of new entrants into the marketplace, and they're writing big deals. They're doing 30, 40 million in some case lends on property developments because the banks simply aren't interested. They're just not in the space. So that'll continue. That because of how cheap money is and how hard to get a return. Obviously, property is still seen as a reasonably safe way of obtaining a return, but also protecting your asset base.
Look, you've got some other points here I'll just quickly touch on, and some finance brokers, if they're watching, I'd love to hear this, using existing equity and equipment to purchase additional equipment by releasing or mortgaging unencumbered equipment. The other one here you've got is studying new technological gains that have been made in your industry. I guess once upon a time, well, back in the before times, people used to go to expos in Germany or America or wherever it was to try and see where the new technology was. What do they do these days?
Well, I think a lot of that's happening online. But even going back to that point, I think Australia over the last sort of 20 to 30 years have become very slow adopters of new manufacturing technology, and there are obviously exceptions to that. But I think generally speaking, when we walk into manufacturing businesses, they are not looking at current technology, and some of that technology, in particular, may lead to significant energy savings as opposed to increasing the speed of production or the output of the equipment. But they're not looking holistically at how they can improve their bottom line by innovations in technology. And there are significant innovations happening across every sector probably more than ever before. But you've got to obviously find time to investigate it, make sure it's going to work for you, and then go through the implementation process, which is purchasing implementation process, which is quite complex.
Okay. Now, you've also made the comment about staff. Are your staff fully trained for the most efficient utilisation of your equipment? Assess each team member's skills and build a training program for it. I mean, do you often find when you go in to value equipment or to do a review for whatever purpose that the people just aren't trained up on it?
Yeah, look, we don't often get to talk in that way to employees of solvent companies, but we do talk to a lot of employees in insolvent companies, and often they complain about the fact that they've not been given appropriate training for the equipment that they're utilising. And look, we've seen that even whether it's in an office environment where you've got staff extensively using Excel, like the Excel spreadsheet, that have never actually had appropriate training to use Excel. They can't do basic things such as basic formulas, etc., and it really holds back the job. At a more complex end, if you're operating a piece of, for example, engineering machinery program, or CNC lathe or something, if you're not across all of the benefits of that machine, and they are significant in terms of what you can do, how many access you can use, and all the rest of it, it's going to cost you. You simply will not be able to get the best out of that equipment. It's like buying a new car and not reading the manual. No different.
What we'll do, Ian, is we're going to pop you back in the waiting room, and we'll bring on our next guest, Marcus Derwin. G'day, Marcus. How are you?
How are you?
Not too bad. So Marcus is a C-suite executive, board director, turnaround and transformation officer, and he's also the managing director of R-Cubed. What is it that's been keeping you busy of late?
Well, good point, Nick. I'd say the last 3 months I've been chasing my tail, and I'll caveat that. I think we're currently in the eye of the cyclone, and I think the analogy there is, we came into this. Obviously, the front end of COVID last February, March. We've had the stimulus package. We've had a budget since that time, which is obviously sought to stimulate the economy and ensure that we have employment. But that stimulus package is coming towards finale. It may be extended. It may be changed in some shape, matter, or form. But the reality is, we need to deal with the fact that when that stimulus package subsides or ceases, we now need to stand on our own 2 feet.
Interesting. I mean, you say that we're in the eye of the storm. I guess another metaphor that's just popped into my head. I'm doing a bit of Greek mythology at the moment. It's a little bit of that maybe we're in the land of the lotus eaters. Everybody. It sounds like you're having similar conversations, if I can read between the lines, that I am. I mean, people aren't feeling the pressure to do something because of all the stimulus. I think that changes that need to be made to businesses are being postponed. Is that fair enough?
Yeah, I think so. And it's a sector by sector, I think, analysis, because clearly consumer discretionary, hitting the lights out.
Yeah.
Any of the retailers who have done a fantastic job in terms of sales, margins, and obviously it's very early stage in terms of mid-year reporting now, but we are seeing those profits flow through. We're having a few more esoteric discussions around, should they have taken that stimulus? Should they be returning that stimulus? But on a positive note, there are sales and there is full employment as it stands at the moment.
It's an interesting question, isn't it? I saw there was one article, I can't remember who it was, I think it was one of the men's fashion retailers, where they had taken masses of stimulus and they're declaring masses of profits, but there wasn't a caveat on the JobKeeper, for example. I mean, you either qualified or you didn't. There was no rule that said that you're not allowed to make profits along the way. So it's a bit of a tough one there.
Absolutely. And look, to be fair to the government, they adopted the let's save them all, which was, I think, the right approach. And it certainly softened the landing. We only have to look at what's happening globally. In other markets, particularly, the Americas and in Europe.
Okay. Well, look, we'll bring back Ian, but I'll stay with you, Marcus. Just having a look at some of Ian's tips here. One of them, he's got to review equipment that's mission critical. Now, I'm thinking that at this stage, it's more than just casting an eye over the assets. It's really looking at the business strategy overall, figuring in, what markets you want to stay in and what markets you want to be competitive in when you're looking at those assets. So any thoughts on that?
Well, a comment, I think, first and foremost, I think that's absolutely fundamental. I think, a review of your business model in the context of the current market, I think we've seen, I think all of us, this is my fifth cycle that I've lived through in 30 years working around the globe. And it's the same as others. It's different to others. And I think that's a challenge. I think we are in the throes of a technology revolution that has been accelerated by the pandemic. I think that's, we've done a good thing. I think fundamentally businesses are going to have to look in the mirror and say, what are we doing today? What are our competitors doing? And what can we do well tomorrow? Because in 3 to 5 years' time, if you're not doing something now, you won't be around.
And how, you heard some of Ian's comments there. How often would you get parachuted into situations, there might be different, crisis or pre-crisis. I mean, how often do you walk around and think, I'm not necessarily an expert on this industry, but they do seem to have a lot of stuff on the floor here in terms of P&E that's lazy or they don't need. Is that something that's obvious to you, but not necessarily obvious to the management?
Yeah, look, a valid comment. Ian, as you know, we've seen many of these situations. But the first thing is, I look at the balance sheet and I wander around and literally, does that asset exist? In what shape is it? What's the replacement value? That has an impact on insurance coverage. And fundamentally, there may be extraneous assets that can be turned into ready cash, which will have an impact on your working capital requirements.
Now, I guess as a turnaround professional, you're obviously, I suppose first and foremost in your mind is that ready cash, because there's no point, you're not going to make the hockey stick forecast if you don't make that valley of death there. But I mean, do you also, is there a point where you also turn your mind to new technologies? Is that part of the process? What other technologies are out there for achieving the same outcomes? I
think you should always be looking for efficiency gains. Just because we did it that way doesn't necessarily mean it's the right way. Yeah. The concept of that is, again, you can explore a range of options which will have impact on your workforce. It'll have an impact on your supply chain. It'll have an impact on your processes. So I think you should always be aware and open and receptive.
Okay, Ian, any reflections on Marcus's comments here, just by way of wrapping up this segment?
Well, obviously, you can't but agree. The other thing I was going to say, just mention that we talked about assets laying around. It's not just the value that gets lost in the asset by the fact that it sits there. It is the on cost. If you look, for example, at a tower crane, if you've got no work for a tower crane and it has a 10-year recertification process and it sits on the ground for 3 years during a recession or because you don't have a contract for it, it's not just the loss of value. It's not just the fact that you've got it sitting in a yard or in a factory somewhere chewing up a heap of space. It's the fact that for your $100,000 recertification process, you've just lost 30% of the value of that. By virtue of the fact that it hasn't been operating for 3 years. So it's really important that it's a holistic review. It's not just about maintenance. It's not just about storage. It's not just about costs that may be 5 or 6 years away. It's about all of those things. And at the appropriate time, you'll be able to buy that crane back probably for less than you paid for it in the right circumstances.
Yeah, I mean, some assets, aircraft and underground mining equipment, I mean, there's all sorts of certifications, and we haven't even touched OH&S type risks. Let's now move on to our next segment, which is takeaways. This is where we have a look at some of the headlines of the week, and we just reflect on what we think about them. And the first one I've got here is loans plan for virus hit businesses after JobKeeper. And they've floated this thing where after JobKeeper runs out, the government is looking at introducing a HEX-style loan program so that pandemic-affected businesses can borrow money to be repaid once turnover returns. What are your thoughts on that, Ian?
I'm not positive, if I can put it that way. And partly, I think it sounds like a great concept, but the reality is, unless somebody's going to vet that business in the first instance, look at the fundamentals behind why it's in the position it's in, and the likelihood of success in the future, I think it's just the government that will be throwing good money after bad. So I would say it's simply not. It simply will not work in the long term.
That's interesting, Marcus. I suppose actually Ian makes a point. I mean, really, this is the government getting into the business of making cash flow loans to small business. I suppose they could set up special agencies to do that. But do you think what are your thoughts on that? Is that something the government should necessarily be doing?
Well, I think there's no shortage of capital running around the market, both from the top end to the middle. tier. I think the sources of that capital addresses most stages of a business maturity life cycle. We've seen a tremendous input in terms of debt and credit funds over the course of the last sort of 5-10 years since the GFC. I would have to question, again, the rationale for that. And as Ian has, pointed out, credit and risk analysis has to be overlaid there to have an understanding. It's one thing to put a dollar out. The reality is you need to get your dollar back and make a reasonable return for the risk associated.
Yeah, well, you make a very good point. I mean, it's interesting. I saw one deal in particular just between Christmas and New Year. It hit my desk, and someone had accessed this $200,000 or $250,000 from the Queensland government. They had a scheme. I think it was no interest for 2 years, or is 2% after that. But on top of that, they had $300,000 or $400,000 from EFIC, which is another government agency, and then on top of that, of course, they had their bank and fintechs. And I'm just wondering, is anybody looking at the overall debt load, because you had this sort of stacking of debt type situation, and it does make it very difficult to climb over. Yeah, I mean, look, it'd be interesting to see if they bring that in. All right, look, let's get on to our next headline. There was a whole lot of articles floating around in the papers this week. Asset bubbles, no worry for low, where our Governor of the Reserve Bank seems to be quite relaxed about the asset bubbles. Wages is why the RBA will keep rates low. This is where the RBA is saying, well, wages growth is going to be anemic going forward, and so that's why rates will probably stay low. With recovery on track, RBA boss sees no bubble, toil and trouble. A bit of Shakespeare there. And what's going on? What do you see this reflected in the auctions and that you get involved in? I mean, I was saying a bit earlier that that one way to value assets is to look at the income stream and divide it by the rate of return. And as the rate of return tends towards zero, then the asset value theoretically tends towards infinity. Are you seeing that?
I think it's just an extraordinary reflection by the Reserve Bank Governor. I have to be honest, I'm not a massive fan of some of the Reserve Bank strategies, and this is one that I think is going to end badly. It may be 4 or 5 years away before that happens, but I think the refusal to recognise that we are approaching unsustainable asset price levels is extraordinary. I just don't know. It doesn't register to me. So I think it's dangerous. And I think the fact there's no wage growth, there are so many other influences in the market other than wages into asset prices. All we've done over the last 2 years is effectively nobble a lot of self-funded retirees who have gone from having a reasonably comfortable lifestyle to literally having to go onto the age pension. And I think we've got to look at holistically from the government's point of view. They've got to have a look at the impact on pensioners and the impact of these asset bubbles, because it's going to have a systemic effect, which is going to be very negative.
Well, it's interesting. I mean, I wonder how many SMSFs are turning into risk takers. But look, we'll leave that question aside. I know earlier in the week, Marcus, when we were talking about doing the show, you had some concerns around asset bubbles and inflation and all the free money sloshing about the place.
Yeah, look, I think again, history is a good guideline for where we are and where we're going. We've seen what happened in Japan with zero interest through the 90s. And it didn't move in terms of asset prices. There's a concern that the government, the Fed, with zero interest rates through the balance of the next decade, has not too many levers to play with. If you're borrowing and gearing up at 1%, you only have to go to 2% interest, and you've doubled your interest. How are you going to service that interest and/or repay that principal? So there's a few questions to be made. I think it's important. Interestingly, they talked in that article around wages at about 1.2%, and they're saying that pricing and inflation's running at 1.5. Now, that's all great when you've got a job, but if unemployment moves from 7 and starts norming up to double digit over the course of the next 1 to 2 years, we've got another equation that needs to be resolved.
And how does we'll talk a little bit in a moment. We'll talk about how this is impacting M&As and IPOs and that sort of stuff. But how does it impact, do you think, on corporate restructuring? Apart from the fact it just seems to put everything into a coma, how do you think it affects corporate restructuring?
Well, I was just going to say that corporate restructuring. I think we're seeing basically, if a business has got a pulse at the moment, if it's got a revenue line, it can be sold. And it may not be for a lot, it may be to take over the employer liabilities. But I think there's a lot of scenarios over the last sort of 3 to 4 months in particular where businesses that might have closed have gone through a sale process and basically the shell's left. At some point, the ATO will issue a wind-up notice. It tends to be the largest creditor. But in the meantime, another company, an independent company often, has bought the revenue line, bought some of the assets, and has plugged on that onto their business. And I think we're seeing a lot more of that. You look at some businesses that are top revenue line based from a sales point of view. You look at things like real estate agents, rent rolls, insurance brokers, businesses, even accountants, professional fees. They're calculated on top line revenue. That's how you calculate their sales. Now, they haven't moved massively, but if you go below that line into the traditional business sense, I think there has been significant drop in yields and therefore obviously increased prices. So if you've got a business with a revenue line, even if it's relatively small, if they're good quality clients, you can generally find a sale for that business.
So, Marcus, Ian's basically saying there that the way it's impacting the corporate restructuring is just that, the businesses are being sold for their revenues, I guess. Is that what you think, or is there any other impact?
Yeah, look, interesting, Nick, and we've seen this over the last nearly 12 months. The dislocation between markets and performance, the economy. So that gulf seems to be getting wider. I'm not sure how we actually bring it back, but the reality of it is along the lines that we need to think about how the businesses are being viewed. Fundamentalists seem to have fallen away. What we're tending to find now is it's around sales growth. It's about customer acquisition. And I think the reality in the current market amidst this technology revolution or evolution is how markets are viewing it. You only have to look at probably the last 6 months of the IPO performance, and really the bourse has always been a viable and more sensible exit strategy than a trade sale.
Yeah, I must say, look, across the way here, I've got Hans Automotive Services. They're a fine bunch of motor mechanics, but I've got a feeling that I could IPO those guys. The way the market is, but look, that brings me to our next set of headlines. RBA's low rates will boost M&A. Ultra low rates fueling acquisition hunt. RBA to set off raging bull markets. So, Marcus, I know myself that we've seen that any decent M&As are certainly very heavily contested. The large funds, I guess, the world that you live in, I'm sort of more in SME land, but you're sort of more in the corporate space. I guess it's the same thing. The big funds are cashed up, and they're all competing for these deals. Borrowing costs are very low.
Look, absolutely. If you've got a performing business, I think you have the luxury of, picking your exit strategy and/or your growth strategy. And I think there's a plethora of either, debt or credit options available to you. I think, people are also looking at, partnering and strategic partners. I think that's an important aspect in terms of growing your business moving forward. I think the takeout for everybody is really what does it look like post the stimulus, and I think there'll be a degree of normality, and I think we have had some parties who've done very, very well, and good luck to them, but there are some sectors that have not done so well. So I think in terms of M&A activity, you're going to see more opportunistic M&A, and that will be where a lot of the special situation funds and some of the mid-market PE funds will be going to, help, good businesses become better businesses.
Do PE firms ring you looking for opportunities, or do they tend to ring you when they need to parachute someone in to clean up a mess, or how do you get engaged with those guys?
A combination. I generally get calls on the basis of a burning platform and/or an underperformance issue in the main, and in some instances that means you need to fix the problem in the first instance. To enable you to basically get a better value for that business going forward, and in both a debt and/or equity opportunity. And I think in that regard, some of the conversations that we were having sort of mid-year last year are fundamentally different to the ones I was having in December. Some of those businesses that were struggling have done extremely well over the last 6 months. I think the challenge will be for the investment market is to work out, have they fixed the business fundamentally, or is there a band-aid solution and they're trying to get a good valuation on an exit?
So do you think, I mean, you said before, eye of the storm, and I think most people in our circles, don't believe that there's not some sort of economic event coming. We don't believe that the real recession's been. I mean, we could be completely wrong, but I guess if the funds are pinning their ears back and bidding up the prices of these M&As and IPOs, I mean, what are they seeing that we're not seeing? Or is it just a matter of the money's got to get out of the bank account and into an asset? Ian, what do you think?
I definitely think that's the case, mate. I think when funds are playing with other people's money, and they've got KPIs and their bonuses, based on money out the door, I think unfortunately there'll always be investments that made later on that you'd think, mate, why did we do that? But that's just reality. Not many funds are prepared to return. Not many funds are prepared to return money to their investors because they can't invest it in a way that it can generate a safe return. So they take the risk.
Marcus, you were going to add something there?
Yeah, look, I think it depends. I mean, good businesses are going to be able to borrow at a much lower rate. And I think the money you're attracting, both debt and or equity, is going to really be a consequence of your business model, a consequence of your management team, and a consequence of your execution capabilities. So I think if you're talking to parties around double digit when you're going to borrow, then the reality is they perceive a much riskier return basis.
It's interesting. I mean, you're sort of saying, I have thought that maybe there's going to be two kinds of businesses. There'll be the ones that can borrow cheaply, and the banks are falling over themselves to lend to those businesses because they're deemed to be safe risks, and there's not a lot of businesses that are deemed to be safe risk. And then there's going to be the other guys that can't raise money. And I think, I have a theory that there's going to be businesses that say, you know what, we survived 2020. We can't guarantee we're going to survive 2021. Let's try and find one of these people who've got passes the money and sell. Would you agree with that, Marcus? Or?
Yeah, look, absolutely. I mean, in some of my analysis, and obviously we're just getting to the mid-year report card, as you know, with reporting season afoot. I discount almost 2020 in some regard and see how were you travelling back through to Christmas 2019, and really tell me, was your business already sort of deteriorating? Or was there margin compression, or were you really seeking to increase? In which case, the pandemic did adversely impact your business. So I think you've got to discount to some extent what's happened over the last 6 or 12 months.
All right. Well, listen, we'll wrap up with our last article here, which is a bit of a change of pace. How to network in the age of social distancing. An article from the Fin Review, I think it was yesterday. Now, I know all of us. I mean, Marcus, you're a little bit different to me and Ian. Ian and I are normally just bound by the Pacific on one side and the Indian Ocean on the other, but you're more of a globetrotter than us. But I think the same thing, the same question. I mean, we luckily, we've all got one or two grey hairs, and we've put in the spade work of building up the relationships face to face over the years, and so we're able to stay in touch with people, whether it's in Perth or Brisbane or London for that matter. What's your advice to people that maybe don't have quite that experience in building networks in this environment, Ian?
Look, I'm a massive fan and supporter of LinkedIn. I think if you approach LinkedIn in a sensible, methodical way, it is relatively easy to get to people that you may have differently in almost any other form to make contact with. So over the years, I've generated some really valuable contacts through direct approaches on LinkedIn, and certainly over the last year, 18 months, because I've had so much time early on, in particular, to be at home. We've really focused on, for example, non-bank lenders, and some of those connections have come through LinkedIn. And then once the lockdowns finish, I've been able to sort of strengthen those relationships by one-on-one meetings or Zoom calls or the like. I've done so many Zoom calls over the last 12 months. I feel like I'm permanently attached to my computer screen, but it does work, and I think people recognise that in these times, that's a very effective and efficient way of communicating and developing relationships.
Okay, Marcus, what about yourself? Because obviously relationships are a big part of your business.
Yeah, no, absolutely. And with reference to my globetrotting, I'm assuming you're talking to my Harlem Globetrotters jersey as opposed to my travel license. The reality of the situation, I think, is your networks are really only as valuable as the time you put into them. I think the medium by which we use, you have to embrace it. I don't think you can ignore it. Certainly, LinkedIn and Twitter are important. I think you've got to stay on message, stay true to what you do, the markets that you work in, and I think the relationships that you've forged over time, will come through in the fullness of time. The takeout is that there's a new generation coming through, particularly 20, 30 somethings who are working in the fintech space as an example. And I think that business is being done a little bit differently, but relationships are still important. You have to invest in them if you want to see some reward.
Yeah, interesting. I mean, the other thing that I would recommend to people to invest in is get a decent microphone, spend a couple $100, get a decent camera, maybe get a light. I've got a light. I look terrible without the light myself. Ian's always an oil painting, of course, but you're spending a lot of time on Zoom. It always amazes me that some people just they don't sound. They've got the wrong sound, and it's just spend a few dollars. You're presenting yourself, particularly in the world we live in. We're normally talking about reasonable size tickets, and I think that's worthwhile. Okay, look, we're going to wrap it up there. I will ask you just for any closing thoughts. I'll start with you, Ian.
Look, I think we're going to have a pretty positive year this year. I think we're going to see a continuing reduction in unemployment. I think we're going to see continuing investment. I don't think that our border's going to open for a long time, certainly not this year and possibly not even next year. But I think as Australians, we're going to learn how to trade with ourselves and do more here. And I think in the long term, having regard to some of the issues surrounding our friends in Asia, we're going to need to become more reliant on ourselves and less reliant on others. So hopefully this is an opportunity for us to really move forward in becoming self-reliant.
Okay, so there's an upbeat Ian Hyman. Marcus, what about yourself?
Yeah, look, I share Ian's optimism. I think the reality is we're learning. We're fast learners in Australia. I'd like to see a lot of this capital that's sloshing around be reinvested across sectors, not just into sectors that they think will be a short-term win. I'd like to sort of see some more medium, longer-term investments, and whether that's a rail link up the East Coast, and whether we create satellite cities, and whether we put manufacturing hubs in there, smart manufacturing. I'd like to see some long-term planning come to the fore during 21. And I think there will be some pain, but that pain probably will be the back end of the year. We can't sort of pretend it's not going to happen, but we do need to embrace it. And I think Australians are very resilient.
Marcus Derwin, fantastic for your first time appearance on Lunch Money. Thank you very much for making the time. And thank you very much, Ian Hyman, for coming back again. And thank you to all our viewers and all of our listeners. Thank you, and we'll see you again. Cheers.